Good morning, everyone. Thank you so much, Sky, for having me on today, and thank you, everyone, for taking the time to dial in. As Sky mentioned, my name is Maria Lee, and I'm a senior market strategist. I sit on the Strategic Advisory Solutions team at Goldman Sachs Asset Management. By way of introduction, our team, the Strategic Advisory Solutions team, is non-product specific. We are multi-asset strategists, and we help clients make sense of the market. To do that, we publish research on all different kinds of topics. Today, Sky has asked me to start with a market outlook. So we'll spend the first 20 to 30 minutes or so of this call on that, and then we'll move on to empower the female investor. So we'll start off with the market and economic perspective. We'll only be looking at the first couple of slides here, but I want to start with an overview of what's happened over the last few months. Over the past few months, COVID has provided all kinds of records to us. We have been witness to the sharpest macro deceleration and reacceleration in history. And that's because the outpouring of monetary policy, of fiscal policy, and financial easing really has dwarfed what we will lose in terms of economic production. What has caused this downturn is very different from what we typically see in a traditional downturn. Most bear markets, most downturns, they tend to be built off of this multi-year financial imbalance. So you see this year-over-year increase, this gradual increase in leverage in the system, or pricing in the housing system, or pricing in tech stock, or rising imbalance in savings and loans. But the bear market that we saw this year was driven by a medical issue rather than a financial or an economic one. And in order to deal with that medical issue and to contain the virus, we had to shut down the economy. We essentially put the economy into a coma to do that. So on slide 1 here, you'll see some of the records that I mentioned earlier. We had record speed when COVID first hit. In late February, the S&P 500 index lost 34%. We declined 34% in just 4.5 weeks. Retracement, the bounce back, has also been very fast. We've recovered from that bear market. We bounced back in just 12 weeks. We then hit a new all-time peak on September 2nd at 35.80. Today, the market's been trading around 34.15, which is just 5% shy of that all-time high. So a common question that we get really is, how is the market where it's at? How has the market only recently notched an all-time record high, given that unemployment has just declined below 10% for the first time since COVID hit, given that we still struggle with these abysmal macro expectations and we're still facing downgraded earnings. And we think that that's because markets have never before seen a backstop like this before. It is truly a policy field recovery. The record policy that we've seen comes in the form of fiscal policy and monetary policy. Fiscal policy, namely the U.S. CARES Act, approaches 13% of U.S. GDP, and it's been sizable and well targeted. The size of the current response is 4 times, it's fourfold what we saw in all of 2008 and 2009. And we think when all is said and done, we should still see more stimulus. The CARES Act should end up at 18% of GDP. The Federal Reserve has also been doing a lot. They've lowered interest rates. They've expanded their liquidity facilities, and they've essentially provided this open-end commitment to broaden balance sheet expansion. And that is worth at least $5 trillion in financial support. So let me just put that into perspective for you. As you read a lot of numbers, let's put it into perspective. At the peak of asset purchases in 2008, that was when the Fed was considered maximally engaged. Back then, the Fed was buying, every month, it was buying $120 billion in US treasuries and mortgages. So in high grade fixed income. During the peak of COVID this year, the Fed was buying $70 billion a day of asset purchases. So everything the Fed is doing currently to stabilize the markets is huge. It's kitchen sink policy. We're throwing everything at the issue to try to solve it. So given this record speed in the markets and the record policy that's mitigated left tail risk, what is our macro outlook? Well, let's take a look first at the sources of volatility in the system. What are the sources of risk in the system? And then let's also take a look at the sources of stability in the system. And that will help to put forth our case and to justify why we have fairly optimistic forecasts, why our chief U.S. equity strategist has a 3,600 year-end target for the S&P, why we're expecting a pretty V-shaped bounce back in terms of economic growth. So for the sources of volatility, there really are three key ones. And we like to call them the three V's. They all start with the letter V. The first being volatility in the markets, this is the speed in the markets. The second being the virus, and the third being voting. So on this slide, still staying with slide 1, if you look at the top right table, here what you're seeing is data that goes back to World War II. And we're asking the question, what are the best days and the worst days in the S&P on a percentage basis? So we're showing you the 10 best and the 10 worst days. And what you see shaded in gray there's 3 cells in each column that's shaded in gray, and 3 out of 10 of each of these days happened during COVID. So 30% of our observations of these most extreme gyrations in the market happened this year during COVID. Now, on the worst day in the right column, that's in dark blue, the market was down 12%. That's March 16th. Now, on the other hand, the best day on the left column in light blue, that's March 24th. The market was up 9%. Between this best and the worst day, that's just 6 trading days of gap. It really is a market of extremes where we're seeing the best days being followed by the worst days with a very short period of time in between. Now, on average in the bear market, the best days are only 2 days after the worst days. So the reason why I'm showing you this table really is to highlight how the best bearish and the best bullish moments tend to happen right on top of each other. No one likes volatility, but that knife cuts in both directions. And the goal that we tell a lot of our clients is not to try to time and to time the markets or to try to identify perfectly when market bottom is. The goal is to build a portfolio that buffers you during market corrections so you can still stay invested, but with a less bumpy ride. You solve for this through good portfolio design, not through clairvoyance. On the following slide, on slide 2, we have the second source of vulnerability in the system, the virus. The way that we solve for COVID has created many vulnerabilities, and a lot of these are unique to this cycle. So at the peak of COVID, we actually hit 13% unemployment. Now, the most recent unemployment number we got for August, that was at 8.4%. That's the first time we dipped below 10% since COVID hit. And these abysmal labor numbers really just reflect the logistics of shutting down the economy, how quickly we went into lockdown. Now, yesterday, the CDC reported that we are at 6.5 million total COVID cases here in the U.S. When you look at the pace of new cases, in other words, the curve, we had 34,000 new cases yesterday, and that's down substantially from the peak rate of daily new cases that we hit back in July, and the peak was actually 74,000. So the U.S. virus situation has improved. We've seen this decline in confirmed case growth from very high levels. And our interpretation of this improvement really is that the low-cost policy changes that we've had over the past 2 months, and we've seen an increase in the share of the U.S. population that's operating under a face mask mandate. It's gone from 40% to 80%, and as well as selective closing of high-risk gatherings in bars and indoor dining. Those things are starting to bear fruit. Now, more is needed, of course, but we don't think the situation calls for another hard lockdown. Globally, we're in a slightly different picture. Globally, we hit a new peak of 29.6 million cases worldwide. The daily rate of new cases at 233,000 versus the peak rate that we hit 329,000 at the end of July. But rather than seeing this decline in the rate of daily new cases, you see this gyration, these sharp moves up and down. So we have not yet seen a marked decrease. It appears that we might have plateaued, but it's really too early to tell. So while the rate of new cases appears to have substantially slowed for the US, globally, we are still very much working on bending the curve. Now, our colleagues in sell-side research, they've devised a scale to measure how reopening of the economy is going. They called it the Goldman Sachs US reopening scale. Now, in February, the scale showed that our economy was 100% open. In February and March, we were only about 37% open. So we shuttered very quickly. We're now at about 72% of the economy open again. So we've done a lot to reignite the furnace, but we still have a lot of work to do to get to 100%. And we expect that states continue to reopen for business. These metrics will recover more meaningfully, bringing the scale to higher levels over time. The biggest shift in our thinking when it comes to the virus and vaccines really is the increased probability that we see an effective vaccine against the coronavirus. We now think the vaccine might be available as early as the end of this year and possibly deployed in developed markets by the second quarter of next year, of 2021. There are around 38 different vaccines that are being tested and 9 vaccine candidates that are already in phase 3. Phase 3 being the final hurdle that is needed to demonstrate efficacy and safety in these large-scale randomized trials. And we expect the FDA to approve at least one vaccine before year-end. The next step, of course, is large-scale production and distribution of the vaccines. And the hope there is to create enough herd immunity to allow for a more complete recovery, in high-contact industries such as air travel and restaurants by next summer. Now, on slide 3, you have the third source of vulnerability in the system, which we think is voting, political risk. Now, in the interest of time, I will keep this part brief. We have a lot of slides at the end of this market perspectives deck that shows our analysis, so please feel free to peruse these at your leisure. And of course, I'm happy to answer any questions you might have. Now, essentially, if we think back 9 months ago, the market was pricing in a very different political landscape. The market was assuming 2 things. The first being that Sanders was the Democratic nominee, and the second was that Trump would enjoy a very strong economic backdrop going into the election. So back then, the prediction markets, and we use this website, this third-party website called predictit.org, and the markets back then were pricing in about 70% chance that Trump would win the re-election. By prediction market standards, that's pretty high. Now, of course, the market has had to substantially reprice. Biden is the nominee, and the economy is not healthy due to the COVID crisis. And historically, we know that there's only been one president that's been reelected during a recession, and that's Calvin Coolidge in 1924. So today, the chance of a Democratic sweep in the fall has increased pretty substantially, and it now stands above 50%. Market pricing has shifted to include this possible blue wave or momentum. Now, on slide 4, at the same time as these sources of vulnerability, we think there are very significant sources of stability in the system. And these sources of stability really have to do with how we were positioned when we entered this bear market back in February and March. When it comes to households, we had consumers in an extremely healthy state. They were saving at 7 to 8% rates versus the 2% that we hit right before the global financial crisis in 2008. Today, consumers are saving at 18%. And household debt to income ratio, so how much leverage households are taking on, They're at 34-year lows. So we know the consumer accounts for 2/3 of the economy, and that's really what's been the driving force of growth over the past decade. This is the first downturn in many years where the consumers are not over their ski tips with maxed out credit cards, where we don't see over leveraged tech stocks, and consumers are living within their means. And that's a good thing for stability, because consumers don't have to massively downsize their spending because it has already been right-sized to start with. Now, I mentioned earlier that many recessions have this multi-year buildup of consumer imbalances, of spending more than they're making, consumer-oriented excess. Now, that's not the case for us today. This recession, we think, might be more recoverable because the classic cyclical problems of recession did not exist in this one. In this downturn, the banks are healthy, households are healthy, the housing market is stable, and FICO scores are at record highs, and they're moving up, not down. So a lot of traditional problems that tend to elongate the recovery are not really in place in this downturn, because COVID is more of a medical issue than an underlying economic or market issue. Now, the other two key sources of stability are fiscal policy and monetary policy. We talked about this earlier, so again, I'll try to keep it brief here. But on the fiscal policy front, the CARES Act, it's well targeted, it's very sizable, and it has a significant portion that delivers direct tax relief to households, stimulus checks, and in small business loans. It's targeted at the most vulnerable areas of the economy. The monetary policy side of things, we've seen that the amount of asset purchases the Fed has done is over 3 times what we saw in 2008. And just last month during the Fed's Jackson Hole meeting, they memorialized their latest shift in policy to what they call average inflation targeting. They've essentially been doing this all along for quite some time, but the fact that they wrote this down and they formalized it is really quite substantial. It essentially tells us that the Fed is going forth and they're telegraphing and telling the markets and telling investors that rather than being preemptive in their approach, they are now being patient. So what this means for us really is that even if inflation starts to take off, the Fed's not going to be particularly concerned. They're going to be patient. They're not going to start to think about lifting rates. So we're looking at lower rates for longer, even if inflation starts to pick up. And we essentially have been seeing inflation at extremely low levels for much of the past 10 years. And low inflation has allowed the policymakers at the Federal Reserve to take the reins off, because they don't have to worry so much about creating a bubble or a price issue. So let me just summarize here on slide 29. You've got some key takeaways. The first being that economically, we have witnessed the fastest market macro deceleration in history, but the macro reacceleration, the bounce back, is likely to be sharp too. And the second being that unprecedented amounts of monetary and fiscal policy that supported us in our path to recovery. And the third is that diversification for us is strategic and not tactical. A lot of the risks that we face today, whether that's COVID or politics or the speed at which the market is moving, these all pose left tail risks, which we think are best served through strategic discipline. So let me just pause here. I'm happy to take any questions over anything that I just talked about or anything in the market and economic perspective, Jeff. Otherwise, I'm also good to move on to the Empower the Female Investor portion. So Sky, I'll turn things over to you.
Yeah, and to tie that together, one of the things I wanted to announce to our staff is that we are replacing our target date fund within our Voya financial plan with Goldman Sachs. And while I pull up the second presentation, obviously your insight is invaluable. You're pulling up data as of yesterday. Can you just give a brief overview of the importance? You had touched on diversification, but for those non-experienced investors, how they can find comfort in a target date, where you guys help them diversify and they're not subject to these types of recessions, if you will, if they're within 5 to 10 years of retirement. Can you touch on that before I pull up the second slideshow?
Yeah, so Scott, I couldn't quite catch your full question. Were you asking about how investors might consider target dates in light of the elevated volatility regime that we're seeing?
Yep. So,
did I get that right?
Yeah, so the diversification, but also the value of the target dates. We have a very diverse crowd of some that are, hitting that target date of 65, but then we also have a younger crowd. Can you speak to how the target dates protect against recessions for those that are within that 5 or 10 years? And how do you guys manage the target dates?
Yeah, so, I think the magic of target dates really is in this hands-off approach, right? That you have this adjustment in your asset allocation that you don't have to worry about. And the biggest thing that we're seeing when the market has a lot of volatility and there tends to be these sharp corrections and bounce backs is a lot of folks trying to time the markets. They're trying to execute trades. And we know that, if you have a time horizon, if you have investment goals that are longer in term, more than 1 year, so we're talking about 5 years, 10 years, 30 years, then you are better served staying invested and maintaining that diversification. Now, within each asset class, if you're looking at large cap equities or you're looking at emerging market equities, there are different ways that, whether you're going with a more passive approach with an ETF or a more active approach with a manager, there are ways to tap into those opportunities that are available that we think are interesting. For instance, currently, in the US large cap equity space, we are at record levels, I believe 23% the last time I checked, in terms of concentration of the 5 largest companies in the S&P. They account for 23% of the index. And if you think about what that means is, it typically when an investor follows or they're tethered to the S&P 500 or the Russell large cap, the Russell 1000, they expect this fairly diversified exposure to the market. But instead, because we've seen these extremely large tech companies start to grow larger and being the primary driver of returns, you're now exposed to more concentrated, more single stock risk. The tricky thing here really is that these companies are all tech companies. They're all very growthy names. They tend to be under very heavy scrutiny with regulation risk, which is something that we think is deserves a second look at. And I think that in a target date fund, you really have that diversification in place that can help you to mitigate those sharp turns and that increased volatility there. So that helps to balance out, we think, the concentration risk that you're seeing just from how the markets are structured, how the markets have been moving over time.
Awesome. Great summary. And to summarize for the CBR employees, we're going to entrust Goldman Sachs with our primary lineup to make sure that you're getting that diversification, that they're paying attention to your time horizon to help protect against these type of things. So I'll be announcing that. I'm actually going to be sending over to Michael Toth to sign off on that today. So that will be announced at our open enrollment meeting. I want to switch directions real quick because I did see this presentation with Maria, and I thought it was phenomenal. It was very eye-opening. And when we look at certain groups that have been marginalized, I think the best way to understand is through education. And it hit me because I know my wife could definitely be making more money than me. She's very talented, and she chose to put our children first. She chose to serve our community through a nonprofit. And there's a lot of education in these slides that help me understand better the challenges for women. So with that said, Maria, we'll go ahead and get started on the second phase.
Perfect. Thanks, guys. So as I mentioned earlier, our team and my role, we get to do a lot of research about all kinds of interesting things. And Empower the Female Investor, the presentation you're seeing in front of you today, really came out of our research from Womenomics. And we're really here today to talk to you about how to engage with new female clients and why it's important. Oftentimes, it feels like the financial industry is very much catered towards men. And I'm sure many of you can relate to this, with all its sports analogies, the bear and the bull metaphors. So it's no surprise that financial planning historically has often defaulted to a man's career path, a man's family role, lifespan, and preferences. So a topic that's resonated a lot with our institutional clients, our plan sponsors, retirement advisors, and our female clients is how we can empower our female investors and how we can empower ourselves as women. Now, on slide 1, I want to start off just by defining Womenomics. And Womenomics, slide 2, Womenomics is the increasing value of women to the global economy. Now, Goldman actually coined this term back in 1999 with research that was initially focused on Japan. At the time, Kathy Matsui, our chief Japan strategist, she wrote a paper detailing one of the ways that Japan could address their multi-decade downward spiral. At the time, Japan had very low birth rates. A lot of the population was getting increasingly older. They had extremely restrictive immigration policies. So their economy wasn't going very well. Kathy was just returning to work after having her first child. She looked around and she saw a lot of her peers actually had stopped working. A lot of women that she joined the firm with as an analyst were no longer working. And she thought that these two might be connected by making some structural reforms that were aimed at boosting levels of female employment. We can actually improve the economy as a whole. So Goldman actually took our research to Prime Minister Shinzo Abe, who was not prime minister at the time, but he ultimately incorporated it into one of the 3 pillars of his reform. So his 3 pillars were monetary policy, fiscal policy, and structural reform, and Womenomics fell under structural reform. The outcome has been extremely positive. Last year, Prime Minister Abe reported at Davos that the female labor participation rate for Japan hit a historic high at 66%. And that exceeds even the United States. Now, over the past 2 decades, we've continued to expand that research globally. We've touched Europe, the emerging markets. The module that we're looking at today, Empower the Female Investor, that was launched in 2015. We turn to slide 3, the next slide. Not only do we do this research, we also invest in women as a firm. We truly believe in the power of women to affect change in the economy. And one of the ways that we demonstrate our support is through our initiative, the 10,000 Initiative. So Goldman Sachs 10,000 Women, that's a global initiative that fosters economic growth. We provide women business owners and entrepreneurs around the world with a business education, with mentoring, with networking, and with access to capital. We've surpassed our initial goal of reaching 10,000 women. We've now reached 50,000 women entrepreneurs. We're in over 26 emerging markets, and we have over $1 billion in committed investment. We're now looking at ways to leverage technology to create a free online learning experience through the Coursera platform. And most importantly, what we've taken away from this program, we've seen that women consistently, time and time again, pay it forward. 90% of the participants in the 10,000 Women program mentor other women. They come back to the program and mentor future generations of women entrepreneurs. Similarly, the Goldman Sachs 10,000 Small Businesses also creates jobs and opportunities, providing access to education, capital, and business support services. We've reached small business owners in all 50 states. We have over 100 local and national partners, and we provide business, accounting, strategy, leadership, education. Now, both the 10,000 Small Businesses and the 10,000 Women initiatives, they recognize that one of the biggest obstacles that female entrepreneurs face around the world is this lack of access to capital, this difficulty when they're trying to apply for loans to grow their business. And we found that investing in women, it drives growth and it tends to reduce poverty. The International Monetary Fund, the IMF and The Economist, they had put together a research piece where they looked at a Women's Economic Opportunity Index. And you saw this direct correlation between the index and income per capita that an economy had. Here in the developed markets, the US, Europe, Japan, only 10% of women are self-employed. But if you're looking at the emerging markets, Brazil, Russia, India, China, it's almost 50% self-employed. So that's why entrepreneurship really is this very powerful way to boost female labor participation rates. And when women do better, economies do better. Now, on slide 4, the reason for establishing the Empower the Female Investor series really is because we believe that women are a powerful and growing demographic, and we cannot afford to ignore that. Women are on course to take on a more commanding role in the years to come. For years now, we've seen more women are attending college than men. There are now as many women with 4-year college degrees working as male college graduates. And in the next couple of years, we're expecting that there will likely be more. That should translate into increasingly higher pay as today's young female college graduates, they start to advance to more senior positions. Women account for 40% or 1.35 billion of the global labor force, with another billion set to come online in the coming decade. So you can see here on this slide that there are a lot of reasons to be optimistic. Women are taking on a greater role in the economy, and we are controlling more wealth than ever before. We are overseeing financial decisions for our families. We're taking on greater professional roles. We're earning larger percentages of household income. In the US, we're educating ourselves and we're earning the majority of all bachelor's, master's, and doctoral degrees. We're starting our own businesses at a greater rate than before. Now, in short, that means we have economic clout. But in spite of all this growing personal and financial power, there are still significant challenges ahead. So on slide 5, oftentimes when we talk to our female clients about investments, about money, it can feel like a taboo topic, like politics or like religion. So of course, every woman has her own unique needs and preferences and will have a different life journey. But we've found some common themes. Unpredictable life events. 9 out of 10 women will be solely responsible for their own finances at some stage of their lives. And that's due to events such as divorce, aging, or death of a spouse. There are economic realities and retirement planning hurdles. Women still earn 20% less than men for the same job. And that's often compounded by unique events like having and raising children and being the predominant caretaker, caring for elderly parents. And that can cause women to be out of the workplace during core income earning years. Additionally, women are living longer. We're outliving our spouse or a partner, meaning that women were more likely to be alone in our retirement years, and we often need to plan for our own long-term critical health care because our partners won't be around to help us. That often leads to fear of making a mistake. Women can often find themselves in precarious financial situations, which can be compounded by conservative asset allocation and lack of confidence. A common question that we get really is why there are so many studies that show women tend to be more conservative than men when it comes to that asset allocation, why women consistently tend to underinvest their portfolios. Because when you're looking at women's longevity, we're looking at higher healthcare costs that women face, it doesn't seem to make sense. Surely the need to secure a larger nest egg means that women should actually be investing more in higher returning, higher growth risk assets because they need to secure a larger nest egg, because they expect to be living longer and they need that return stream, that income stream for longer. Now, the financial planning challenges we discussed earlier, those unpredictable life events, economic realities, and the retirement planning hurdles All of those can lead many women to fear making mistakes. And I think it's important really to note that in spite of the massive strides forward that we've made in terms of women's rights and equality, some of these developments occurred not so long ago. Here in the US, women couldn't vote until the 20s. And until the mid-1970s, it was not illegal for institutions to demand that a woman who wanted to take out a loan had to come in with the signature of a male relative. We've spoken to clients even who, when they, at the beginning of their careers, they wanted to take out a loan, they had to come in with the signature of their male relative to support their application. So of course, we as women tend to be more cautious with our investments. We are in an unprecedented spot today where women are set to control $22 trillion of wealth in the US, but almost half of us report not having grown up with a financial role model from our parents. So that leads not only to underweighting risk assets, it also leads to a prolonged gender wealth gap and also greater dependence on Social Security. Of the women over 65 who are living alone today, 4 out of 10, almost at 46% depend on Social Security for virtually all of their
shares? Hey, everybody, let's mute your phones, please. Stephanie, can you mute your phone? Stephanie, I need everybody to please mute your phones because we can't hear. Sky, you should be able to mute everybody if they're not muted as the host. Thank you. I am so sorry. Please continue.
No worries. Okay. So as I was talking about, this often leads to not only underweighting risk assets, this prolonged gender wealth gap, but also greater dependence on Social Security. Out of women today who are over the age of 65 and living alone, 4 out of 10 of these women depend on Social Security for virtually all of their income. And we think that these challenges can be overcome through education, through good planning, and confidence building. As an example of some of the economic hurdles that women face in particular, we constructed this hypothetical scenario based on average earnings in the US. So if we assume that a similar college-educated man and a woman both work full-time from age 25 until age 65 in management jobs in the professional services industry, and then we say every year they get a 2% wage increase because of the inflation rate, we find that over the time of their full career path, women will earn $500,000 less than the average man at age 61. And that means that women consequently will have to work an additional 4.2 years to make up for that differential. Now that differential can actually, we're making a lot of assumptions in our hypothetical about equality, which actually, reality does not support. But the differential can actually be many multiples of this 500,000 if the woman takes time off of work to care for children and elderly parents, or retires early to care for their spouse. And studies do show that women tend to be, the predominant caretaker. They tend to take on that caretaking role at a greater rate than men. Now, the sacrifices that many women make, they result in lower cumulative lifetime earnings. And sadly, these sacrifices are not recognized by Social Security, which is based on a person's formal employment, their 35 highest earning years. So what does this wage gap mean for retirement savings? Now, if we assume that in our hypothetical, the woman and the man save at equal rates, they save 1% of their gross income, and they put that into a tax advantage savings account every year until age 65. And then we say, let's assume the market gives them a 7% annual return that's compounded over time. It shows that women who already step back with the wage gap, when combined with the power of compounding, they have even less than men in retirement savings. So this is all on top of the fact that women already live longer than men. And it means that they now have to work longer, first to close the wage gap, Second, to have enough income for retirement. And third, to fulfill greater healthcare expenses. For example, did you know that women over the age of 65 actually have 2 times the estimated, they are twice as likely over their lifetime to have the risk of developing Alzheimer's compared to men? Did you know that women in the US spend about 7% more on healthcare every year than men? And on average, pay an additional $194,000 in healthcare costs through retirement. And due to the greater likelihood of longevity, of widowhood, and reliance on long-term care later in life. So if we turn to slide 6, how do we address these issues? How do we address this lack of confidence, this conservative asset allocation that we often see with female investors? Well, women tend to approach investing differently oftentimes. And the main difference is that for many women, return might not be the only factor in investment decision-making. Among other goals, studies have shown that women prioritize wealth preservation. They prioritize lowering shortfall risk. And they also prioritize helping others. 77% of women say that they see money in terms of what it can do for their family. And 2/3 of women say that they want to invest in causes that matter to them, environmental, social, and governance causes. So it's important to understand, to communicate to your female clients that you're willing to use, to take into account their priorities in investment decision-making, to make this a collaborative experience, and to emphasize any experience that you yourself may have in dealing with these factors. When planning for women, it's also essential to acknowledge that this is not a monolithic market. We are all different. Our concerns and our financial needs are unique. And here on this slide, here we can think about some of the common financial concerns and needs among women with varying priorities. And we can think of it in terms of roles. But do keep in mind that many times women often play dual roles, and they hold a variety of concerns and have many financial needs. A woman could be, for instance, a caretaker. A woman's life can revolve around others. She could be a wife, a mother, a daughter, a sister. Women tend to focus not only on themselves, but also their family. So their concerns are broader in nature. 80% of women have children during their lifetime, and on average, they have 2 children. So women are more likely to make trade-offs for family than men are. And they often experience what is called a mommy penalty, this pay gap that's caused by lost income and missed opportunities for promotions by taking time out of the workforce. So for many women, it may make sense to plan for these potential career interruptions and to factor them into retirement planning, and perhaps developing a power of attorney, will, or healthcare proxy in case of emergencies. The responsibility of caring for elders also disproportionately falls onto women. 2/3 of elder care is done by women. This is a very rewarding role, of course, but again, may need planning, especially if time is taken out of the workforce, which again can lead to lost benefits and promotion. The average caregiver spends $7,000 a year on their care recipients. And oftentimes, this money might come out of the same pool of savings that is earmarked initially for retirement. So we know that life is chaotic. Life can already be hectic. And with the caretaking responsibilities that women have, that means that they have even less time to dedicate towards financial planning, saving, and retirement planning. So the second role that we often see is as a working professional. Women represent half of the US workforce. So you might think about how to build your business with more women clients in terms of their roles as a working professional. 9 out of 10 women, studies have shown, will be solely responsible for their finances at some point in their lives. And yet when we talk to a lot of our clients, even high net worth female clients, many of them report taking the back seat. Even if they earn the majority of income in their household, they allow their husbands to make all the financial decisions for the household. We also know that Around 1 in 5 marriages end in divorce, and oftentimes the settlements that come out of divorce may not favor the woman, who may not have had formal employment. She may not have invested all that time in a consistent career. She might have made those trade-offs in order to care for her family or elders. And the average age of first-time widowhood is 55. Women live on average today 5 years longer than men. And with the developments in technology that we're seeing, many could live a lot longer. So these concerns and these needs, we think they need to be synchronized with the financial services that we provide. And only then is a client more likely to see the relationship as a natural fit. Now, this is a powerful and it's a high growth cohort of clients that you really don't want to miss out on. These are important clients. And when we look at financial advisors that segment of the market, 69% of women do not use a financial professional. 75% of women under 40 do not have a financial advisor. And even the quarters that do have an advisor, 2/3 of them are unsatisfied. So this is estimated to be a $5 trillion market. Now, many women think they might not have enough money to start planning for retirement, which is often the most common cause for under planning. 19% of women use financial planning websites or apps, and we know that 70%, the majority of women, fire their financial advisor after their husbands die. So this is business absolutely that we encourage and we think we need to be going after. As retirement consultants, as plan sponsors and financial advisors, you add a lot of value. And more than half of the women who engage with a financial professional to manage and plan for their retirement, they consider themselves on track to achieving their financial goals, versus less than 1/4 of women who are unmanaged. So let me just pause there. You know, this is obviously a webcast. I'm happy to share any useful information that I might have had in my work with advisors, institutions, or individuals. As Sky mentioned earlier, that there are different modules that you can leverage. We have 3 different modules. The first being a 2-page preview that summarizes what we have to offer in the Empower seminar, what we have to offer in this full-length seminar, and interactive exercises in the workbook. So you can use this as a teaser for marketing. Second, we have an end client seminar presentation, which takes you through our 7 steps of Empower. And we have both, we have Empower the Female Investor, we have Empower the Millennial Investor, Empower the LGBT Investor, and we're also coming out with Empower the Black Investor. But all of them share the 7 steps of Empower. It's a mnemonic, and it makes it easier to approach some of these difficult topics and these complex planning challenges. The third we have, which Sky talked about, and I believe he's going to touch on in more depth, is the workbook, which you can take that workbook and use it for interactive exercises during a seminar. You can hand that out as a takeaway. So in summary, we talked about a lot today. We walked through why it makes sense to market to women. If you aren't focused on them already in your practice, you should. We walked through the financial concerns and needs of women. We talked about best practices and how you could build your business. And so, I challenge you really to set some goals for your practice and for building your business. Step 1, you've attended this seminar, which is a huge step. Step 2 can be running an event or planning an event that might be geared towards prospecting for women clients. And step 3 really can be going through the 7 steps of Empower, either in our workbook or in our seminar, that takes you through this process, helps your clients to plan for their future and to take action. So let me just pause there. Sky, I'm happy to go through the 7 steps, but I want to be respectful of time. And I know that you also want to touch on the workbook, right?
Yep,
Let me hand things over to you.
Yep, in the last 5 minutes, what I'd like to do, the message to our employees is it's a lot of good data. I an absolute gem. We're very excited to be able to offer Goldman Sachs as our target date investments within the 401k. I do have a bunch of these workbooks here in the training room. I've been handing them out. This would be a starting point. Using me as a point of contact, if this is something that you would be interested in going through a program, we can definitely set a meeting to go specifically on this. We do work with CFPs as well. That if anybody wants one-on-one, I know I personally use one. Noemi has. I think Jackie's talked to one. I know Kim Barner has a great financial advisor that she can share. So we want to take care of the 401k, so to give you good peace of mind there, but we also want to provide an extra resource for those that do want to go through these steps. And if there's enough interest, we can do a separate meeting to just focus on this topic. But I did want to reiterate that we are rolling out these funds. I will mention them at CBR's internal meeting, but really use me as a point of contact. I helped put this together. Michael and Rory and Maria have been great. But I did want to open up the floor, since we've gone through a lot of data, to just finish our time. If anybody has any additional questions for Maria. And you can either unmute or you can go through the chat and I'll read them on if you have any questions. Okay. I don't see questions at this point, but using me as a point of contact, please send them to me, and I'll get you on the right place. We do have an awesome Goldman Sachs team for the more intricate questions. And when we do roll out the investments, one of the things that I really like that Goldman Sachs does is they give you awesome links to keep up on these market analysis. They supply progress reports to let you know how you're doing within your target date fund. So it's going to be a very educational rollout that we're going to be doing this fall. Okay. With that said, if there's no final questions, Maria, I want to thank you very much for your time. I know that we tried to do this in person. We would love to see your smiling face maybe next year. But thank you for helping pull this together at the last second. And we really appreciate you.
It's my pleasure. Thank you so much for having me.
Awesome. And last announcement, I did record it, the meeting, for anybody that had to drop off early or couldn't make it. Joya or Leticia is going to put it into a YouTube link, and I'll send it out to you later this afternoon. And if you're watching from your desk, we still have donuts available in the training room. Everybody have a great day. Thanks again, Marie.
Thank you. Not at all. That's the one thing I'm always like, but what are we doing about it?
Education.
Yeah. So like, I mean, like you're talking about like your wife, like I didn't even do any of that. I've been working since I was 16. I'm still behind.